Hello and welcome to Business Arena on TVP World. I'm your host, Marie Cato. Join me for the latest business headlines of the day. Poland's biggest private TV stations, TVN and Polsat, are going to be put on the list of strategic assets, Polish Prime Minister Donald Tusk said on Wednesday. This comes on the heels of media reports about the possible sale of TVN to a Hungarian media group. Prime Minister Donald Tusk said that if a company is put on the list of strategic assets, it cannot be sold without the government's consent. He said that the rumors of TVN being taken over by a Hungarian businessman with ties to Hungary's right-wing government are being taken very seriously. He added that the government would not allow hostile states to interfere in Poland's affairs. TVN is currently in the hands of the US-based conglomerate Warner Brothers Discovery, which is looking to sell the TV channel to prop up its finances. Poland's largest energy company, Orlen, has announced it will scale back the development of a landmark petrochemical plant. While continuing construction is more viable than scrapping the investment, the returns will be a drop in the ocean compared to the outlays.
This massive metal structure, called Olefiny 3, was once set to become Europe's largest petrochemical investment. But this dream has been cut short by basic principles. Orlen's CEO, Ireneusz Fonfara, explained that his predecessors failed to account for critical project components and underestimated the construction time, financing costs and capital expenditure. Polish Minister of State Assets, Jakub Jaworowski, a key figure in reforming Poland's state-owned enterprises, which includes Orlen, told TVP World that this was an independent decision made by the company itself.
This decision was entirely made by the management board, but my understanding of the situation is the following. The project costs much more than initially envisaged and brings much less EBITDA than initially envisaged. So it's a purely business decision driven by the fact that the profitability is much lower than anticipated, if there is any profitability at all.
Initially, the Olefiny 3 project was estimated to cost almost 2 billion euros. Soon that figure more than tripled. But now Orlen's new management says it would cost nearly 12 billion euros to finish the project. But even after scaling back, the project's cost will run into the billions. So far, Olefiny 3 has consumed nearly 2.9 billion euros. Contracts worth an additional 5.3 billion will fund its redevelopment into the new Nowa Chemia project, deemed as the most viable option. Still, by 2030, the restructured investment is expected to generate only a maximum of 187 million euros annually.
How do you go from relying on one supplier to completely shutting off the tap? As of December 20th, Poland and other European countries won't be able to import LPG or liquid petroleum gas from Russia. The secret was quiet diversification of sources, and data shows a remarkable drop in reliance on Russian fuel over the past few years.
Zero LPG from Russia as of December the 20th? Poland proves it is possible. Poland will stop allowing imports of Russian LPG, bringing shipments of this fuel from Russia effectively down to zero. While the country has already diversified its LPG sources, data indicate a steady decline in its reliance on Russian gas over recent years. With the cut-off imminent, Poland's energy sector has focused on securing supplies from elsewhere.
We redirected supply routes to Scandinavia, the United States, Western Europe and the Middle East. And thanks to the readiness of Polish ports, we successfully secured deliveries.
Unimot, the biggest LPG importer in Poland, even chartered a gas carrier to ferry the fuel from North Sea to a rented terminal in German port of Wilhelmshaven.
We had to make logistical preparations, as Polish ports have certain limitations regarding the draft of ships, an issue we began highlighting to the market as early as 2022.
Market watchers have noted that LPG prices are rising. Since July, the price of LPG at Polish pumps has climbed, now hovering around 0.7 euro per litre. This spike raises questions about the impact on consumers.
Ta nowa logistyka z Europy Zachodniej, Stanów Zjednoczonych.
In 2023, the new logistics from the United States and Western Europe did have an impact on prices. However, we worked through this period and optimized the logistics. Currently, the so-called land premiums on oil products imported to Poland have almost returned to pre-war levels.
This matters for Poland's drivers, as 3.5 million cars, or about 17% of the national fleet, run on LPG. Consumption reached nearly 2 million tons in the first half of 2023, driven not only by motorists, but also by growing use in agriculture, industry and refrigeration. With secure, diversified supplies and ongoing market adjustments, Poland's shift away from Russian LPG marks a pivotal moment for both energy security and consumer interests.
So in less than 2 weeks' time, the EU will stop importing liquefied petroleum gas, a fuel of great significance in Central and Eastern European countries. Here in Poland, the focus is on what life will look like with no more Russian LPG. On the bottom line today, we want to look at the impact and concerns stemming from those sanctions. To find out more, stay with us for The Bottom Line, coming up right after the news. Power China, a Chinese construction company, will start works on the first subway line in Belgrade, the capital of Serbia. This makes it another infrastructure project in the country in which companies from China are involved. For now, Power China is only responsible for the first phase of the project, which the government expects to be completed by 2030. So far, Chinese companies have mainly been involved in the construction of motorways and railways. In September, the government launched the construction of a new connection between Belgrade and Novi Sad, which will be built by Shandong High-Speed Group. Chinese companies are also involved in the new high-speed rail line connecting Budapest and Belgrade, which is a part of the Belt and Road Initiative. The luxury goods market in Poland is growing rapidly, having expanded by a quarter last year and reaching some 13 billion euros. At the same time, the number of wealthiest taxpayers has surged by 11%.
Many Poles complain about the cost of living, but at the same time, the market for luxury goods in Poland is booming. According to a report by KPMG, a consulting firm, the market for premium products in Poland is growing significantly faster than in 2023. It is expanding more rapidly than other sectors of the Polish economy, having grown by 24.6% last year.
The Polish luxury goods market rose fivefold in just 15 years. It's important to compare this to global markets. Global luxury goods market grew only threefold in the last 20 years.
Premium cars are the main category of luxury goods highlighted in the report. Their sales reached 8.4 billion euro last year, an increase of 35%. Another sector, luxury hotels, grew in value by nearly 17%, reaching 1.8 billion euro. Premium real estate rose by a little less than 7%. Other sectors, like luxury alcohols, cosmetics and clothes, saw less significant increases. The report's authors stress that what constitutes luxury goods changes over time.
For the purpose of this report, we defined luxury goods as those which are considered luxury at the point in time. They're branded as luxury and regarded as luxury.
The growth of the luxury goods market is fueled by rising earnings among Poles. The number of Poles earning more than 28.4 thousand euros annually increased by a third last year. At the same time, the number of Polish taxpayers in the wealthiest category, those earning more than 234,000 euros a year, grew by some 11%.
And that's all for our business news updates today. For more business stories, check out tvpworld.com.